Hello everyone, how's it going? If you're looking to buy Nikola Motors stock, NKLA, then please keep watching because we're going to look at the company's recent news, the markets, up and down, and what are the technicals telling us, and most importantly, what would be the best approach given the current circumstances. The market remains a very volatile place at the moment, and we should always be careful which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few days, Nikola has been trying to tread above the water by trying to stay above the $1 level, which is critical for companies to stay listed on a Nasdaq. Of course, companies can always declare a reverse stock split in order to reduce the number of shares in circulation so that each one of them is worth more. But doing so tends to backfire massively on the company itself, as the market often sees this as a vote of non-confidence and may decide to cash out their position in such companies, causing a massive sell-off following such announcements. We have seen it with the likes of Molen, that sometimes reverse stock splits are not a solution to address the failing share price, but like an additional compounding of the problem. For now, the question is only occasionally raised in people's mind, because we don't have to deal with the question for the most part. There may come a point when this issue has to be addressed in a more straightforward manner, and Nikola would have to come up with actual solutions. I, for one, don't believe that fundamentals can save the company's fortune, but it seems like it might very well be saved by the potential changes in the next interest rate updates, and that the subsequent increases in equity valuations will also reflect this. Of course, things are not always set in stone, especially not as far as Nikola is concerned. In fact, a few years ago, many people have already written this company off, assuming that's going to bite the dust before most of them do. And in fact, many have since then bitten the dust, but not Nikola. So we still have to see how the real economy is going to react to the next Fed announcements. For the time being, the fortune of Nikola depends on its external forces, and we should be able to see more clearly in the upcoming weeks. Now, let's also take a look at the technicals. The trading volume of Nikola has recently been around 38 million shares versus an average volume of 48 million shares. Over the previous 52 weeks period, the price fluctuated between 50 cents and $3.71. The volume of shares tells us how many shares are being bought and sold at any given point in time, and if there's enough liquidity to support its trading strategy. If the float is thin, it would be easy to influence the stock price, but also mean that the demand is limited. When we compare the current volume against the average volume, there might be the possibility for a trend reversal or breakthrough if the difference is very large. The market cap of Nikola is currently around $981 million compared to an enterprise value of $780 million. As we compare the current price to the historical price fluctuations, the stock is 16% higher than the 1-month low, 24% higher than the 3-month low, and 93% higher than the 52 weeks low. On the options market, which often gives us a hint on the market sentiment on where the stock price is likely going to head next, the implied volatility is 109% versus a historical volatility of 75%. The put-call volume ratio is currently at 33%. It is normal for most stocks to also have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 20,000 contracts a day versus the average volume of 60,000 contracts a day. Regarding the open interest, most recent volume of open interest is around 1.6 million contracts, compared to the 30-day average of 1.7 million contracts. Regarding the shareholder structure, institutional shareholders own about 22% of the outstanding shares. The biggest ones include BlackRock, Vanguard, and Citigroup. Usually, it's always good to see some institutional participation when holding a stock long term, and I would say that in terms of Nikola, it's actually much like the institutional ownership is actually higher than what I've anticipated. We have to remember that this is a company written off by most years ago. That ever since the Trevor Milton, showdown, a lot of people were like, "Whoa, this company is just built on fraud, right?" So it's not really worth in investing. In fact, if anything, this might explain why this company is still below the minimum threshold, in my personal view, of between like 25 to 30% for institutional ownership, for me to like consider the company as something to invest in for the long term. Of course, there are exceptions, but in this case, I wouldn't say that I would put money into Nikola for the long term. If I want to buy Nikola, if I want to, it would be because that I want to trade the shares. I want to trade the ups and downs. The current short interest is around 21% of the total float, and 55% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume, and a significant portion of the short volume comes out of the dark pools, it may suggest that there are institutional positions taken to short the stock, and there would be potentials for a short squeeze. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So, really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. What I would recommend for Nikola is to wait a bit, see if the $1 level is something that they can hold with confidence, and then go from there. The current price may be good enough for an initial entry, but more commitment needs to be supported by the market movements. It is overall a worthy position to have for trading portfolios looking to benefit from volatility upticks. I would recommend to commit overall between 0.5 to 1% of your portfolio in this stock, and would recommend to split the allocation in batches of 10 to 20% so that you may purchase more in case of retracements.